afternoon, and welcome to Unlock the Stock. As you know, this platform was created for retail investors to connect with corporate management and gain a better understanding of them and their companies. Unlock the Stock is sponsored by Easy Equities, a platform that helps you to grow and protect your wealth, where you can invest in local and international shares, property, unit trusts, cryptos, bonds, and actively managed ETFs. Plus, you get access to Easy Protect life insurance and Easy Credit lending to back your financial journey. We're pleased to welcome Pan African Resources to Unlock the Stock. And as you may know, Pan African Resources is no stranger to the platform. And today we're joined once again by Kobus Lutz, the CEO. Kobus will take you through a presentation shortly. Unlock the Stock is only possible with our technology partner, Lumi Global. You can visit their website at lumiglobal.com to discover more about their various online AGM and investor presentation solutions. Today's Q&A session will be hosted by the Finance Ghost and Mark Tobin. Before we start, there are a few housekeeping notes. The presentation will be followed by a Q&A. You can post your questions by typing them into the Q&A box at the bottom of your screen. The event is being recorded and will be available on our YouTube channel soon. When we begin the Q&A session, you will see an email address, and if you would like to be added to Pan African Resources investor distribution list, please jot down that email address. I am now going to hand you over to Kobus, who's going to take you through the presentation. So Kobus, if you and Hethan can share the screen and take us through the presentation, please.
Great. Thank you very much for having us this afternoon, and I trust that everybody can see the presentation. So we'll keep it fairly brief, probably around 20 minutes or so, and then we'll open the floor for questions. Go overview. Let's start health and safety, which would be slide number 6. We always said we can't operate if we can't operate safely. On a positive note, I think a number of safety achievements over the last 12 months, and certainly specifically the surface operations they are doing fantastically well. Pretty much no last time injuries on any of the surface operations for the last year, and a number of milestones. Regrettably, we did have a couple of fatal accidents, and we're working hard to ensure that those do not recur. So that's a key focus area for us in the next year. The group overview in terms of investment highlights on slide 8. It's a really well-diversified portfolio now of producing gold assets located both in Australia and South Africa. Established production of circa 200,000 ounces a year. That was for the year that's passed, but obviously we're growing production very materially in the year ahead to, in terms of production guidance, 275 to 292,000 ounces for the 2026 financial year. That's an increase that we're forecasting of circa 40% in terms of production. There's not a lot of gold counters that can give you that growth in the short term. Portfolio of long life assets with really significant resources and reserves. A proven track record of investor returns that we will discuss in a little bit more detail, with obviously a very attractive dividend. Experienced and proven management team. We've been around, we've seen a number of cycles in the past. And then certainly the ability to leverage the existing portfolio to grow further. So we don't have to go and buy expensive assets at these gold prices in order to be able to grow our production in the years ahead. And we can discuss some of the growth plans on the next slides. Slide 9, share price performance. Obviously, we've done very well in terms of the share price recently, but the first time I bought Pan African stock and became a director in 2009, I think I bought these shares at 45 South African cents. Obviously, attractive dividends pretty much since 2009, but it's a 38 times return on investment, excluding dividends. If one includes the dividends, it really looks even more attractive. Major shareholders, number of blue chips institutions, both in South Africa and also elsewhere. And then importantly, I mean, we did the move from the A market to the main board of the London Stock Exchange some weeks ago, and we also expecting some index flows as a result of that move. So, quite happy to have gotten that done. Sort of very briefly, slide 10. We'd like to think a pretty unique combination of underground mines in South Africa and then also surface mining in South Africa and also in Australia. So it's not a lot of producers that have the underground, which gives you long life of mines and sort of solid returns on investment as a result of quite significant sunk capital over many decades. And then also the surface mining operations. South Africa, we call it tailings retreatment. And that really has been a fantastic boon for Pan African since we really commissioned our first gold tailings plant at Barberton in 2013. And we can discuss that in a bit more detail. And then slide 11, successfully really sort of over the last years, we have transitioned from being solely an underground South African producer to now sourcing more than 50% of our production from surface tailings retreatment, but then importantly, even more of our earnings as a result of the low cost nature of the tailings business. Operational snapshot in slide 12, Tennant Mines in Australia. I mean, that just gives you quite a bit of detail, but then the surface operations in South Africa, MTR, Elikhulu, and BTRP, and then the underground assets in South Africa, Evander Underground, and then also the 3 underground mines that we have as part of the Barberton portfolio. In terms of operating successfully in South Africa, we have a long track record. Barberton Mines has been going for 140 years uninterrupted. So that sort of tells you something about the ability and the quality of the asset to really sort of see through cycles and continue to operate. There's some slides on the focus we have on renewable energy that we can discuss. Importantly, our mining rights in South Africa are long dated. Evander until 2038, Barberton 2051. MTR will extend in due course. And then really good relationship. We'd like to think with our unions and employees, generally long-term wage deals in place. We focus on going beyond compliance in terms of ESG. One specific example would be the blueberry operation we have at Barberton that employs some 200 to 300 women. And it really has been a big plus for us in terms of stability in the community and goodwill as far as our operations are concerned. Illegal mining is always an issue. It's more of an issue when we have gold prices like we do at the moment. It continues to be a focus of ours to make sure that our people and our assets remain safe, and we are able to manage the situation as far as illegal mining is concerned. Key features from FY25. I'm not going to dwell on that because it's well past, but decent sort of production. Production was up some 6%, and then in the second half of the last financial year, it was actually we achieved record gold production with MTR producing, and then also production from Australia. Obviously, sort of all-in sustaining costs, decent performance, and the focus of ours is to ensure that we continue to maintain our margins from an all-in sustaining cost perspective. And then obviously, I mean, we had the benefit of a much higher gold price, but importantly, I mean, it's in terms of the gold price received in the last financial year, it's nowhere close to what we're seeing at the moment in terms of margins. We then just go to performance by operation, and let's just quickly recap on slide number 18. We'd like to think a very successful track record in terms of bringing new projects and specifically tailings retreatment operations to account. Just to quickly recap, BTRP, as I said, this was our first foray into gold tailings to some $28 million, paid itself back in 18 months. ETRP, which was the precursor to Elikhulu at Evander, payback of under 36 months. Elikhulu, which is one of our flagship tailings retreatment operations now, 33 months payback. MTR at this gold price, we're going to be paid back pretty much in the next, pretty shortly. So that's been a great investment for us, and we'll discuss some of the plans for MTR in the next slides. And then obviously TCMG, our first project or operation in Australia. We managed to get it going and running in record time, and we expect a very short payback on that investment also. If we can just go into a bit more detail per asset, Elikhulu, as I said, a flagship for the group, stable production, 52,000 ounces. We expect to do quite a bit more than 50,000 ounces in the year ahead. Really a competitive all-in sustaining cost, and some 9 years of life remaining at Elikhulu. So this asset, obviously, at these gold prices, generating fantastic cash flows for the group and for shareholders, and it, as I said, is a proper flagship for us. BTRP and Sheba Fault. So, I mean, when we initially commissioned BTRP 2013, we planned for it to run until 2021. Now, we've again extended the life, so we have some 6 years of life remaining at BTRP. The all-in sustaining costs will go up to about $1,400, but still very competitive. I mean, we've taken more than 8 tons of gold out of the BTRP from when we started operations. So it's been an incredibly successful business for us. And then it'll go for certainly 6 more years from tailings. And after the tailings, we will proceed then to start treating what, from a Barberton perspective, would be lower grade underground ore bodies, specifically Western Cross Royal Sheba, but some 3 grams per ton, and that will go for many years. So certainly a long life asset as far as the BTRP is concerned. Well, MTR or Mogale, it's been, as I said, a fantastic success for us. You might recall we bought this, all of us, 2 million ounces circa in reserve. When we were done with our work, we bought off a liquidator for about $2.5 million. It really was a very good deal for Pan African. We then proceeded to build a plant and commission this operation ahead of schedule, below budget. And currently we're doing about 50,000 ounces a year. We've also announced an expansion to 60,000 ounces, and that expansion will be done in December. So we'll see an uptick from a production perspective. All-in sustaining cost of about $1,300 at the moment. We look to try and get it down going forward. But, you know, what a good success for us. And there were quite a number of skeptics in terms of our ability to construct and then operate in what was considered to be a very difficult part of Johannesburg in terms of, obviously, communities and illegal mining. But very happy to report that things are stable, and we are having a massive positive difference in terms of our operations on the communities, eradication of illegal mining, etc., etc. Also, we mentioned that we're busy doing a feasibility study on an expansion of this operation. So to take a step back, so the initial expansion to 60,000 ounces is close to being done. But then we have a huge reserve base, principally as part of Mogale, and then also what we call the Soweto cluster. So there's a feasibility that we are now pretty close to completing, and you can expect an announcement in the next couple of weeks as far as the roadmap for expansion is concerned. But as I said, it's a huge reserve base, and it makes sense to look to expand further. And we really would like to start remining Soweto for the benefit of those communities. So just watch the space as far as an announcement is concerned. I mentioned the really positive socioeconomic impact of this project. We are rehabilitating what was pretty much before our involvement an impossible situation to fix. And I mean, the beauty of this business and operation is it's massively profitable, generating attractive cash flows. At the end of the life, we will also leave a site that is rehabilitated, and it'll free up land for other uses. The water quality is also much improved as far as our involvement is concerned. Then Tennant Mines in Australia, also a fantastic acquisition for us. I guess we bought this just at the right time. Gold prices were starting to increase, but they were nowhere near where they are at the moment. It's a gold field that we own pretty much all of at this point, tier 1 jurisdiction in the Northern Territory. We started production and we reached a steady state at this operation in July. Long mine life. Now, I mean, you can expect some level of clarification as far as the mining is concerned by February when we put out our interim results, but it's looking really good for us as far as TCMG is concerned. Slide 26, just some of the operations and targets, just demonstrating the potential of what we have in Australia. And then, as I said, slide 27, we are now fully commissioned on our CIL plant. It was done ahead of schedule and on budget. It's not often that you buy an asset in a tier 1 jurisdiction and then proceed to commission within 6 months, which is what we've done. And yeah, so guidance for the year ahead is some 40, 60, 50,000 ounces of gold. As we stabilize operations and get into some of the open pits, you should also see the all-in sustaining cost decreasing quite nicely. And then lots of growth potential that we can highlight. Slide 28, we have a copper gold asset by the name of Warrego. We have other open pits and underground mines that we will be accessing in the next while. So it's a very positive development for us as far as Tennant is concerned. Just a picture of the plant in Northern Territory on the next slide. And then underground operations. Yes, Evander Underground, it's not been the easiest mine for us, but we've invested heavily now in infrastructure, principally in cooling, and also in a sub-vertical shaft for hoisting. So that was commissioned earlier in the year. And you can expect a much better performance from this mine in FY26. And really, it's a quality ore body. I mean, the B line where we're mining at the moment, some of these panels grading 70 grams per ton or more. So it's great to see, and it's great to see a recovery as far as the Evander Underground is concerned. Fairview Mine at Barberton, it's really the mainstay of the Fairview Underground Complex. Still a life of 20 years, with most of the gold coming from the MRC ore body. Doing a lot of development there to make sure we can stay ahead of the game also. But as you can imagine, again, at this gold price, Fairview and the smaller mines at Consort and Sheba generating attractive cash flows. And really also nice to see the turnaround in Consort, where production is up to now annualized about 10,000 ounces a year. Consort obviously contributing to the bottom line. And then Sheba, a number of restructuring initiatives we undertook, reducing the workforce, and that also will benefit us in the years ahead. In terms of all-in sustaining cost, I think it's a decent cost performance for the group. So certainly Pan African is by no means a high-cost producer. And at this gold price, obviously the margins are fantastic. And slide 36, just briefly, just where we rate versus the rest of the global gold mining sector. I think very competitive from an all-in sustaining cost perspective. And that really is where you want to be, obviously generating a lot of cash at this gold price. If, heaven forbid, the gold price went down, we still would be very competitive from a cost perspective. ESG, very briefly, beyond compliance, as I said, very proud of the good work we do. We build schools, clinics, water. We are in the process of building 2 additional water retreatment plants, one at Evander, the extension of the existing plant, and then also a new plant at Mogale, investing heavily in our local communities. And then from a rehabilitation perspective, as I've said, also very positive. Other than Mogale, all of our liabilities are fully funded in cash. And over the life of Mogale, that rehab liability will reduce to something that's pretty insignificant, which is also a big positive. In terms of solar, renewable energy, we were the first gold miner to commission a large-scale solar, 10 megawatts at Evander. We then built another circa 9 megawatts at Barberton. We're really seeing the benefit from a cost-saving perspective of operating these facilities. Hopefully, we'll start construction on a new expansion at Evander, another 20 megawatts before the end of this financial year. Also looking at a 20 megawatt facility at MTR, given the life and just the attractiveness of this project. And then signed a power purchase agreement with NOAA, and we should have a first power in the next 18 months. So it's quite conceivable for us that in the next 2 years or so, we should be sourcing more than 50% of our energy from renewable initiatives, which I think is world class. I won't speak about the financials. That really is old news. But I mean, the gold price we received in the last year is significantly lower than what we are currently achieving. So that's obviously a positive. Plus the really big increase in gold production. So you can work your own numbers from a financial perspective. Importantly, we have guided that we should have no debt from a net debt perspective before the end of the financial year FY26. And we're really seeing a positive cash flow generation at the moment. And as a result, obviously, we managed to increase dividends also. So subject to the upcoming annual general meeting, a dividend per share should be up some 80% already in US dollar terms, and that dividend will be paid at the beginning of December. Then just to conclude on the presentation, areas of focus for us in the next while is certainly continuing with our focus on health and safety and zero harm, achieving production cost guidance, successfully executing into capital projects like we have been doing, ESG initiatives, and our social license to operate. Shareholder returns has always been key for us, sector leading in terms of dividends, and then also returns on capital. That will continue. And then obviously exploring local and international growth opportunities, mostly within our own portfolio, because that's generally where you return or generate the best returns, is in developing your own assets, which you don't have to buy. So that is, in short, is the presentation. Thank you very much, and let's open the floor for questions.
Perfect. Thank you so much, Kobus. As always, I'm going to now hand you over to Mark, Tobin, and the Finance Ghost. So just as a reminder, if you haven't already done so, please pop your questions into the chat box below. Over to you guys.
Thanks, Vanessa, and thanks to Kobus for the presentation and for coming back and joining us once again. And welcome to we've got here 102 people who've joined the call today. Thanks very much for taking time out of your day to join us here at Unlock the Stock. Kobus, I just want to kick off questions maybe on the renewables piece. I know you touched on it in a couple of slides. I mean, given we've seen the reduction in load shedding over the last kind of 12 or 18 months in South Africa, is you guys still seem to be doubling down on the renewables piece. Is that purely now on a cost perspective, or are you also doing it as a kind of an insurance policy if we get a major resurgence of load shedding into South African operations? Who knows what might happen with Eskom in 12 or 18 months' time?
Sure, yeah. Obviously, it's important from an ESG perspective to demonstrate a positive move in terms of one's impact on the environment. So that definitely is a consideration. But as far as costs are concerned, I mean, we've seen a massive benefit from these renewable initiatives. Between Barberton and Evander, I mean, we generate a monthly cost saving on these plants of circa 9 million rand. So, I mean, you can imagine what the cost saving would look like when we commission the next phases, which is 20 megawatts at Evander, building another 20 megawatts at MTR, and then getting power from a power purchase agreement with NOAA. So in order to be continue to be internationally competitive, I think it's a competitive advantage. The African producers all run big fleets of yellow equipment. They can't use renewables to the extent that we can. So in terms of keeping our all-in sustaining costs down, we think it's a great initiative. And then, our sense is that Eskom's not going to get any cheaper. So to the extent we can safeguard our long life operations by reducing costs and generating excellent returns on renewable projects, we'll continue to do so.
Hi, Kobus, and to the team and to everyone attending, thank you for being here today. I should actually disclose before we start that I'm a shareholder in Pan African. So thanks, Kobus. It's been a lovely year on my share portfolio, of which you've played a nice role there. A great year for gold. I think a lot of investors are now paying attention to gold. In some cases for the first time. They may not necessarily have really dabbled in it too much. And in this year, obviously, gold has been amazing. So one or two of the questions I think are worth a little bit of a gold 101 in some respects. And perhaps a nice place to start with that is just how hard it is and how you guys go about actually planning out your capex, trying to figure out what the gold price trajectory could be. I mean, I read the prospectus when you moved to the main board there in London, and there was a very nice comment in there about how gold has a less volatile supply and demand curve than other commodities. Central banks certainly play somewhat of a, I want to say, a stabilizing force in terms of gold, but it kind of is that. From your perspective, in terms of trying to forecast how gold will behave, how that affects your capex, I mean, you've got a lovely margin now versus your mining costs, which certainly helps. But how do you actually go about doing that, all the factors that affect the gold price, and trying to figure out what that might do, down the line? Because that's what makes mining so hard, right? You got to do these multi-year educated guesses on what the commodity is going to do.
Sure. Look, I mean, it's if we knew what the gold price was going to do, obviously was no need for us to have this call, and we'd sort of be sitting on the beach somewhere. I think the first comment is yes. I mean, the gold price is excellent at the moment. I mean, if you asked us 12 months ago if we could have foreseen this price, I would say to you, over the short term, probably not. But I mean, the world's not in a happy place, and I mean, we can spend a lot of time talking about the reasons for gold being where it is. For me personally, I've been involved in the business for a long time, and it also feels like this has been a long time coming in terms of de-dollarization, central banks playing a huge role. And the beauty, I think, of where we are at the moment, gold being the second largest reserve currency now for central banks, it's really in nobody's interest to see the gold price depreciate significantly. I mean, we are, as you point out, we're in a really nice spot where, I mean, we don't need this really high gold price to make excellent returns. We managed to commission 2 new projects pretty much at exactly the right time. If you sort of had given us a 10-year line graph and sort of asked us to, with the benefit of hindsight, select when to bring new projects to account, we really couldn't have been any more fortunate. So, I mean, the bottom line in terms of our capital planning and the way we look at investments is the current gold price is great. It feels to me like there might be even further tailwinds in times to come. But certainly when we plan on acquisitions or undertaking capital projects, we take quite a conservative view on the gold price. And one of the metrics that we are quite adamant on achieving is a payback on investment of, say, 4, maybe at a stretch 5 years. And if you look at our track record as part of this presentation, you could see, all of the most recent 5, 6 projects have all really shot the lights out from a payback perspective. So, I mean, the bottom line is we're in a really good space, generating attractive cash flows. We have long life assets that are not running out of life soon, and the current tailwinds and windfall, if you so choose to call it, in terms of gold price, allows us to capitalize even more, develop a couple of other projects or expand a little bit. We also have, through the cycle, invested into our assets. So it's not like we have to play huge catch up from a capex perspective in terms of the ongoing operations.
Kobus, I just want to talk about hedges here for a second, because you didn't really touch on it too much in the presentation. Can you just give us an update on where you are with current hedges, and now, given the gold price, what is the plan with hedges? As these ones roll off, are you going to stick to what you've done traditionally, or has the board's kind of view changed in terms of the hedging policy?
So the answer is quite easy. We have no hedges in place. From the 1st of July, investors are 100% exposed to the Rand gold price. So the reason we undertook hedges in the last couple of years was we needed to have those in place to fund MTR. It was the biggest capital project we undertook in the history of the business, and the banks were adamant. Clearly, the banks are way less adamant now. Our view on hedging is that most of our shareholders want a direct see-through to the gold price. The only reason to hedge is if you're protecting a capital program or you're protecting dividends. There's no need for us to do so at this gold price. As I said earlier, we're still very much on track to be de-geared before the end of the financial year completely from a net debt perspective. So the board will continue to monitor the situation, but most shareholders would prefer for us to be unhedged at this prior point.
Yeah, thank you.
keen to maybe get some feedback, just because now you've done the whole capital markets game in the UK. I'm assuming you've spoken to some investors as part of the move to the London main market. Just wearing my proudly South African cap, what is some of the feedback that you're getting from the international investor community? Is the South African story a bit more positive now? It feels like there's been a lot of positivity around us this year. And I'm keen to hear if some of that has come back from the investor community. Obviously, not all your assets are in SA, but a big part of them are. And maybe there's some interesting stuff to learn there about how the international investors are perceiving us as an investment destination at the moment.
Yeah, so the move to the main board in London was very well received. I think when we announced the move, the share price went up almost 10% on the day. And despite us having a very material presence on AIM for as long as I can remember, interestingly, there are still a number of larger investors that do not invest on AIM. So together with the gold story plus the main board listing, we've seen a lot of interest. I would expect, and there's been some research that would be included as part of some indices in the next couple of months. So that should also have quite a positive impact on share price liquidity. In terms of South Africa as an investment destination, I think we've, as Pan African, have differentiated ourselves. We're not a traditional deep level South African miner. And the fact that there are so few international investors historically, call it over the last 10 years, that have looked at South Africa has really opened an opportunity for ourselves. Example being the acquisition of MTR, as I said, 2 million ounces on surface in reserve category that we bought for pretty much nothing. There's nowhere else in the world that you'd be able to achieve that sort of outcome. I think a benefit for South Africa has been, from a relative perspective, we look more attractive. The rest of Africa, West Africa now, given all the challenges in terms of that's sort of well publicized, et cetera, relatively, I hope that international investors recognize that South Africa looks better, stable. And it's important that we project that image and attract more international investment like Pan African has been doing.
I used to live in Australia for about 5 years, and I have actually driven through Tennant Creek, so I know roughly where you're on the. We did a big road trip from Adelaide to Darwin, so obviously we passed through there. Very remote location for South African investors who might not know. Plus, you've got the added complication of a full-on wet season there for like 6 months, which is no joke in the Northern Territory in terms of roads and bridges that are just not passable for a couple of months' time, and everybody just plans around it. So I'm keen to kind of get your take on how that impacts capex and workflows and just generally operating in such a remote location with such a high seasonal impact of this is the period to get work done in, and then everything kind of comes to a halt for 5 or 6 months, and then it's all's going blazing for another 6 months.
It's when we managed to construct the processing plant despite the wet season. The worst time is generally December, January, and for the rest it's quite manageable. So we managed to do that through the wet season, and obviously we have contingency plans in place to continue to operate. All I can say, we're taking an approach that Australia should be run by Australians. We're not sort of exporting a huge number of South Africans to go tell Aussies how to do things. Clearly it would be the same as getting Australians into try operate deep level South African mines. It doesn't generally work. So we've retained pretty much all of the management team through the acquisition. They're well incentivized, and we're very much aligned. And I've had to say the Northern Territory has been a great area for us to start operations. The political support that we've had has been incredible. You walk into ministers' offices and they ask you, well, how can we help you? At the opening, we had 2 Northern Territory government ministers present, and they were very complimentary. This has been a very big success story for the Northern Territory and for the territory attracting foreign direct investment. So we definitely have support there, and it's great to own pretty much all of the gold field. I have to say, and the exploration potential in in Tennant Creek is incredible. So the team did well in terms of constructing the infrastructure, and what you point out is it's a very remote part of Australia, but there are benefits to operating in a remote area also. There's very few people around. Our security budget is very small, and we have a dedicated workforce, and we are critical to the future of the town of Tennant Creek and the area. So that's also a big plus.
I feel like you need the security budget just for the snakes and the spiders more than the people. When I hear about remote Australia, it just sounds frightening. So maybe another like gold 101 kind of question. And again, I'll just encourage the people on the call, like send through your questions on DMs if there's something you want us to ask. But I think what's really interesting, Kobus, is that sort of surface mining versus underground. And you spoke about it earlier. There was a very good chart that you had there with the different costs per ounce of your surface operations versus your underground operations, which was very cool. I guess these are very different CapEx profiles. It would actually be lovely to just open the floor to you to get a few minutes of like very high level, surface versus underground, a couple of pros and cons. It doesn't have to be, I can imagine that's a topic that could fill 10 hours, and I know that.
Sure.
But I think just to help investors who are kind of getting into gold for the first time this year, when they read about underground or they read about surface, when they read some of these things, all-in sustaining costs, etc., it's great to just understand more about, as you sit there and allocate capital, you look at potential acquisitions, you try and figure out where you want to take the group. What are some of the top of mind factors around risk, costs, profits, CapEx across these different things?
Sure. Well, let me start out by saying that Pan African has been incredibly successful on commissioning and then operating gold tailings retreatment operations, with obviously the two flagships in the portfolio now being Elikhulu and then MTR. And as I said, you can expect a level of announcement on MTR and expanding operations further. So we also have a great team. So to be clear, it's not easy to build a project like an MTR, which was a 2.5 billion rand circa project, and do so ahead of schedule, below budget. Generally, miners are not known for coming in below budget or for beating schedules or timelines. So kudos to our team. Look, there are also challenges. You remining 0.3 grams per ton, which sometimes that gets lost in sampling error. So you have to be quite focused on achieving returns. And then we always build some flexibility into these plants on pushing volumes where recoveries or grades drop slightly. But again, the team has gotten it down to a T. So yes, these are great flagship assets for us, and producing at an all-in sustaining cost of say $1,200 per ounce, generate a lot of attractive cash flows for our shareholders. So you can almost sort of view that as, say, the baseline for Pan African. And then the underground, most of the gray hair you see on, from my perspective, is the Evander underground. It's not been an easy asset for us, but we've invested quite heavily in terms of capital. I'd hate to have a portfolio of 5 Evander undergrounds, but we can manage the one. And because of the capital we've invested, this is a really big ore body. We have a big reserve base, I think 5-6 million ounces. Out of all of the Wits basins, it's probably the least explored or exploited, even though there's been 10 shafts that have been sunk. And yeah, it's really a focus for us, just sort of slowly building up from there. The beauty, again, is we don't have to go spend billions of rands of capital at Evander underground. It's mostly spent. So I certainly wouldn't call it harvest mode, but the asset should generate quite attractive cash flows in the coming years. And then Barberton underground, I keep saying there's no other ore body, or ore bodies rather, because it's, like just a number of ore bodies. There's nothing else like it in the world. I've not seen anywhere else where you find so many ore bodies, and after 140 years of mining, we still discover new assets and ore bodies. So it sort of sometimes say it's the gift that keeps on giving. So yeah, we're pretty much on top of the underground assets, even though they're higher cost. They obviously generate attractive cash flows. They give us optionality in terms of developing new projects if the returns make sense. And then it's nice to have Australia now also as part of the mix, where you have a Crown Pillar stockpile, which we're treating at the moment. You have open pits, which we haven't yet had for a while in our portfolio. And then you have also the undergrounds, but these are mechanized Australian undergrounds, nowhere near the level of complexity that we have operating 2.4 kilometers underground at Evander. So we like to think it's a nice portfolio. Sort of these assets balance them each other out. And I mean, obviously, one gets the portfolio effect now where some assets underperform a little bit, some overperform, and then on balance provides for a more predictable and reliable ounce profile go into the future.
Cobus, I've got one of my DMs here around Tennant Creek and kind of looking beyond 2025 and 2026. Can you give us a sense of, what needs to be done on maybe expanding those open pits and, getting that kind of surface level mining like really up and running there?
Sure. Yeah, look, it's all in hand. It's being done, and what we have said is as part of the interim results in February, we'll provide more guidance and details on just the production profile. But as far as Australia is concerned, but yeah, I mean, generally it's very positive. From when we did the acquisition, there's an asset by the name of White Devil, which we own jointly with our joint venture partner Emerson. I mean, this is turned out to be 300,000 to 400,000 ounces open pittable, which really wasn't in our mine life. So, that tells you something about the just the prospectivity of this gold field. So what we've said is that by February, we'll give more details on production going forward and then also CapEx. So just watch the space.
Okay.
Keen to understand a bit more about some of the costs that maybe keep you up at night in terms of in the underlying mines. I mean, obviously labor must be quite a big one. I would imagine energy. I know you've done a lot of renewable energy type investing as well. I guess there's some stuff like automation to help with handling that around labor. Could you just kind of give us an overview of the big cost pressures that you find in mining? I mean, it's tremendous at the moment when the gold price is so high that the money is literally just falling out the ground at the moment, but it obviously is not always like that and hasn't always been like that. So which are the costs that you do worry about, and where are there opportunities to become even more efficient?
So labor, as you point out, certainly from an underground perspective, is always an area of focus. But I have to say, on a positive note, the unions have become a lot more pragmatic and reasonable as far as wage demands are concerned. So, I mean, our wage bill going forward for the next couple of years shouldn't really increase by more than, say, 5% in South African rand terms per annum. And we have generally longer term wage deals in place. That's a plus. We've seen big increases in reagents, which obviously impacts our tailings businesses the most materially. But those costs seem to have also now stabilized. Our reagents used to be, principally cyanide, used to be cheaper than export parity, no longer the case. So we don't anticipate huge increases there. And obviously the stable and fairly low oil prices assisting there. Electricity has been a huge sort of issue for us in terms of the uncompetitive and unsustainable increases from Eskom, which is why we're pushing renewables so hard and will continue to do so. And I mean, the great thing is with, as you point out, the cash flow generation, we can now invest into the future in terms of building as much renewable capacity as possible. But overall, from a Pan African's perspective, our costs are really well controlled. So it comes down to a unit issue. We have to produce the units of gold, and then the unit cost of production is very much manageable. And fortunately, as we said, I mean, we fairly competitive even globally from an all-in sustaining cost perspective, and will continue to be so, and even more so as we commission new lower cost operations in the group.
Rubus, I've got an interesting question here in my DMs. Just wanting to know if around the broader industry, not so much Pan-African, but has there been a pickup in companies looking to buy ounces underground that maybe are still far away from being produced? So in other words, assets you might be looking at but you're hearing, there's kind of new interested parties coming to the play. Given the kind of high gold price, it is going to attract in, I guess, people to relook at old assets. Look at the gold space with like fresh eyes. But from big global miners or kind of some other outside interest, re-looking at South African assets with a fresh view, given the gold price. Have you seen that kind of dynamic enter the market yet?
Look, I mean, I think most investors, as you guys said in the introduction, they were underexposed to gold. So there's a lot more investor interest from generalists also. I mean, in terms of the South African space, if you think about it, there's not, that many gold producers remaining. It's ourselves, Sibanye, DRD, and Harmony, really. And between us, I mean, we have pretty much all of the assets sort of tied up. We wouldn't really sort of look to get in partners in this gold price environment. It's difficult enough to manage assets without sort of partners. But yes, I mean, certainly from the east there, I think there's a renewed interest in gold and in South African gold mining. I mean, we were discussing this morning just that some sort of, say, from a Chinese perspective, some markets might have closed for them, which could make South Africa more attractive. But I mean, like we sort of, as I said earlier, I mean, one can't plug in the current gold price into models when you're assessing opportunities. And whenever a sentence starts with like in the current gold price environment, you should open a mine or reopen a mine. I think one needs to exercise caution. Like it feels like there might be even more tailwinds, but we certainly would not be making investment decisions at the current gold price. We'd probably be running closer to $2,800 to $2,500 an ounce. And then you have a robust project that can withstand most cycles.
Let's just talk about illegal mining if we can, while we still have time. So, I mean, you mentioned earlier that, specifically at MTR, it's very stable, etc., in terms of the community engagement, and that's just one good example. What would you say have been what steps are happening out there, to the extent they are happening, to try and stop the illegal mining? Everyone's seen these stories a million times in Joburg. Is it still as bad as it was? Is it getting better? Is something actually happening there? What is the lay of the land as part of this risk that you need to try and always manage?
So, I mean, as far as MTR is concerned, I mean, we don't really have a big issue with illegal mining at our operation. I always say, I mean, the safest place to store your gold, even better than a safe, is just our tailings facilities, because nobody can extract the gold economically other than ourselves with a 2.5 billion rand facility. In the case of
that's a great line. I like it.
Yeah. No, but it's true. It really is. I'd much rather have a gold in tailings. I mean, you do have illegal miners still operating or exploiting waste rock dumps or outcrops. But yeah, I mean, it's sort of under control, and we use technology to great benefit at MTR. Won't elaborate too much. I mean, our biggest issue is Barberton, which again, it's such high grade and just a huge influx of illegal mining and foreign nationals, mostly Mozambicans, Zimbabweans, etc. So it's something we have to definitely keep tabs on. If we let up, then it would be a matter of weeks and we would be completely overrun. So we have an excellent security team, and I compliment them on a very regular basis, the really good work they do. We do also have better collaboration with police, but it's something that can enjoy even more attention, I think, from a South African government perspective. And I mean, we've been lobbying for a minimum sentence as far as gold theft or illegal mining is concerned. I mean, there's no point in arresting somebody and then fining them 500 rand for trespassing, and the next week you arrest the same person again. So yes, I mean, the minister has been quite vocal around illegal mining, and there's definitely more steps to be taken.
Yeah, at 500 a fine, it feels like it's just the cost of doing business. Pay the fine and try again.
No, exactly. It's not great, and it's unsafe, and people pass away. It's tragic. It shouldn't be happening.
Mark, you're on mute. Committing the cardinal sin of hosting. There he is. He's
Sorry,
back.
and it's still there. I had a frog in my throat. I was trying to clear while Kubus was answering and then forgot to put myself back on. Question just on the Blueberry Farms piece. The question here wanted to know, is there potential to expand that? And I know maybe you've kind of looked at their operation, but the guys from New Hope Coal are actually based in Australia. They had one of the biggest coal mines just outside Brisbane, which has been rehabilitated now to, it's like one of the largest like cattle producers, beef producers in the whole of Queensland now, on the back of what used to be an old open pit coal mine. So, I think in terms of if somebody wants to go and look at what can be done in terms of these rehabilitation, community upscale projects, maybe that's one, but maybe on the Blueberry one, maybe just give us a little bit more insight there on plans to expand it and just how that fits into the whole ESG and community relations program that Pan operates.
Yeah, look, it's been a great initiative for us. As I said, we employed 200-300 women, local women, mostly women, from Barberton. It's brought us a lot of goodwill from the community. It's very difficult for corrupt politicians to stand up and sort of point a finger at Tennant Mines when we do way more than what they do. So great team of people managing the operation. We had, some issues with frost and et cetera, et cetera. If there's one industry that maybe is even more difficult than mining, it's probably agriculture. So, we must be careful not to lose focus. I mean, Tennant Mines underground life of mine of more than 20 years still. That's where we focus. As I said, good team of people, and we might look to expand a little bit there. But, unfortunately, blueberries does not generate the returns that gold does, certainly at these prices. So our focus remains gold, but very proud of what we've achieved, and would welcome investors going to visit there, and they can see how well it's run and what a positive difference it makes in the community.
Maybe last one from my side, just around deal making in this environment, because now gold is so hot right now, right? It's the old Zoolander joke, and everything is therefore really good. And I guess any gold asset is now effectively trading at a premium, whether it deserves to or not. And we know from deal making, so often you make your money on the way in, not on the way out. So I guess the question is, as you look to allocate capital in this wonderful environment where the cycles really come to you, the money's fantastic. That discipline around what you buy and what you do with it is important. Do you think there's still bargains, there's still good deals to be found in this environment, or does it feel right now like the assets that you could acquire or look at are probably trading a bit hot?
Yeah, it's we've always been very disciplined from a M&A perspective, and nothing's going to change. One of our sort of key incentivization measures is relative outperformance in terms of return on equity, etc. So we're definitely not going to do stupid deals. There's no need for us to do so. There are very few other counters that can grow production like we are doing 40-odd%. Certainly none of the majors can come close. So we also have, as I said, a number of interesting internal projects, both on tailings and potentially just some smaller expansions underground. Those we can do, and we will bide our time as always. Can we get our money back 3-4 years at a, say, $2,500, $2,800 gold price? Then we'd consider it, but we don't have to. And as you say, you make your money when you do the deal, not when you sort of not after. So we're very cognizant of that fact, and we really are in a good position in terms of not having to do anything to maintain and increase production.
Great. I'm going to jump in here while there's some silence from the guys. Cobus, thank you. That was a really great discussion. Thank you, Hethan, for arranging it for us. And thank you to everyone who chose to spend time with us on this call today. And thank you to you guys again, Pan African, for supporting this platform of ours and engaging with the retail investors. Our next session is going to feature a company that hasn't been on the platform before. Their name is Octodec, and they will join us in a session on Thursday, the 27th of November. So we hope to see the retail shareholders on that one. And then that is all from my side. Thank you very much and goodbye. Thanks again, Kobus.
Thank you very much.